If you had invested just $10,000 in 1994, you'd have over $225,000 today. But if you did nothing, you'd still have just $10,000. Let me show you how. It's 1994. You and your neighbor both make $32,000 a year. Both of you decide to save 10% of your income, $3,200. You stash your cash. It's safe, secure, and untouched. Your neighbor, he invests in the S&P 500, an index that tracks the 500 biggest companies in America, tech giants, financial titans, healthcare leaders, and energy powerhouses. Here's where it gets crazy. Fast forward 30 years, and it's now 2024, your cash is still $3,200. The neighbor's investment, $72,000. That's 22 times your money. And if you had invested $10,000 instead, you'd be sitting on over $225,000 today. Most people don't realize how much playing it safe is actually costing them. Over the past 30 years, the S&P 500 returned about 10% annually, fueled by human labor, globalization, and technological advancements. But the next 30 years, AI and automation could push returns even higher. AI doesn't sleep, it doesn't take breaks, it doesn't need health insurance, a pension, or sick days. It optimizes, scales, and accelerates productivity beyond what human labor could ever achieve. And the companies leading the AI revolution are the same ones dominating the S&P 500. Microsoft, for instance, is investing billions into OpenAI, integrating AI across its products. Google is pioneering AI search and deep learning with Gemini. Tesla is developing AI-driven robotics and self-driving cars. NVIDIA is supplying AI chips that power everything from ChatGPT to autonomous systems. And Amazon is using AI to streamline logistics, cloud computing, and automation. History has shown that technological revolutions drive massive wealth creation. The question is, will you be a part of it? Here's the problem. The US money supply is always increasing year after year as the Fed keeps printing more money. More dollars in circulation, less purchasing power for each one you hold. A dollar today won't buy you the same as the dollar tomorrow, but the stock market? It's a hedge against devaluation. For example, $10,000 in cash today could only be worth $6,700 in 20 years with a 3% inflation rate. To illustrate inflation's impact, here's what $100 could buy you in 1990. About 50 gallons of gas, 10 movie tickets, or 50 loaves of bread. Today in 2025, you could get about 20 gallons of gas, 4 movie tickets, or only 20 loaves of bread. Inflation punishes savers and rewards investors. The choice becomes simple: own assets or get left behind. Imagine your 60s and 70s. Travel, time with family, and financial security. But today, more Americans are working longer just to make ends meet. In the early 1990s, the average retirement age was 57. Today, it's 61 to 62. And it's not just about living longer. Social Security is in trouble. The Social Security Board of Trustees projects that the trust fund surplus will run dry by 2035. After that, benefits could be slashed by nearly 20%. So, you can either wait for a check that may not come or build wealth on your own terms. Here's the good news. Unlike your neighbor in 1994, today you can invest with zero brokerage fees on apps like Robinhood, Fidelity, and Webull. So when you go to buy or sell a stock, there is no fee. Remember, stock picking is risky. Index funds offer a low-cost, diversified way to invest. The S&P 500 index spreads your money across all sectors of the economy. Sectors such as tech, finance, healthcare, and everything else. This diversity limits your risk if one industry in particular doesn't do well. But what happens if you invest right before a big market crash like Japan in the 90s? This is why we employ the dollar cost averaging strategy. With dollar cost averaging, you invest a fixed amount consistently, like $100 per month. This reduces the impact of market volatility and ensures you build wealth over time. And the best part, apps like Fidelity and Robinhood let you automate this so you don't even have to think about it. So do you invest all of your money? No! Holding some cash is smart. It's stable and ready to use instantly. I personally believe you should have a 12-month emergency fund held in cash. And this cash can be held in a high-yield savings account earning 4 to 5% APY, making cash more useful without the risk of inflation wiping it out. But beyond emergency funds, investing is the key to long-term wealth. Every decade, there is a reason not to invest. The dot-com bubble of 2000, the 2008 financial crisis, or COVID-19 crash in 2020. But every time, the market rebounded stronger than before. Meanwhile, AI is rewriting the rules of productivity, and those who invest today will own the future. So the real question is, will you be the one watching your wealth grow, or just watching time pass you by?